Namaskar and good evening to one and all. On behalf of Karnataka State Chartered Accountant Association and the Direct Tax Committee, I extend a warm welcome to all of you on this special webinar on Union Budget 2025. The much anticipated Budget 2025 has been unveiled. Looked at from the point of view of number of amendments, probably it is among the smaller budgets that we've seen in the recent years. But having said that, we still have plenty to discuss even under this budget. While the new Simplified Direct Tax Act is set to be introduced in a week's time, today's budget has already brought a host of amendments and significant reliefs in the current tax regime. These changes will have far reaching implications for taxpayers, businesses, and professionals alike. We are privileged to have CA Naveen Khariwal sir with us today, a well regarded speaker and expert in taxation. His analysis will help us decode the key provisions of this budget, their impact, and what we should expect going forward. A warm welcome from all of us, sir.
Thank you.
I encourage everyone to participate actively and share your perspectives and make this session interactive and insightful. Before I hand over the proceedings to Naveen sir, a brief introduction of Naveen sir. Sir comes from a family of chartered accountants. Grandfather, father, brother are chartered accountants. He specializes in direct taxes, was co-opted member of Direct Tax Committee of ICAA New Delhi for the year 2021. Currently member of Central Taxes, Corporate Laws and GST Committee of FKCCI. Member of Study Circle Study Group of Committee of Chamber of Tax Consultants Mumbai, was a member in Finance Advisory Committee of the Karnataka State Cricket Association Bangalore, Karnataka, was a part of team nominated by Bangalore branch of SIRC of ICI to represent before Honorable R.V. Ishwar Committee for Simplification of Taxes, coordinator, moderator, speaker at numerous forums across the nation. He has been a resource person in seminars organized by over 50 branches of ICI across the country. He is also a keen cricketer, having represented college and university matches and played in league registered in Karnataka State Cricket Association and represented in cricket matches organized by Bangalore branch versus Income Tax Department 3 years continuously. Led the cricket team of Bangalore branch of SIRC to national level cricket tournament organized by Pune branch at Pune Cricket for MIT 2015 Pune. He was also the captain of the team which won the cricket tournament organized by KSCAA along with Bangalore branch of SIRC. Above all, he is a mentor, a guide who has practical solutions to legal issues and income tax. He possesses this amazing skill to strike the perfect balance between the law and practice of income tax. With this very brief introduction, I now wish to pass on the proceedings to Naveen sir. Sir, over to you, sir.
Thank you, Deepak, the introduction and for invited me to deliberate on the provisions of the Finance Bill 2025. So let me tell you, ladies and gentlemen, at the outset, that we are now in 2025 and the most important amendment made by the Modi government since he's taken up the post of the Prime Minister of this great country since 2014 till today, Modi 3, you have the biggest amendment of the decade is a new Income Tax Act. Mr. Modi would be unwilling, along with his Finance Minister, Madam Nirmala Sitharaman, who has given her 8th consecutive straight budget. That is also a record. So now, we'll have to wait for the next week when this budget will be put into public domain. I had not given the updated resume to Deepak. So I am also now the member of the ICAA Direct Tax Committee for a comprehensive relook at the new act and also for giving suggestions. So in any case, there will be ample time. I cannot disclose what has happened during the proceedings where we speakers all over India, we got together and, we gave certain suggestions and many suggestions of the ICAA would be accepted by the government, and you can see in the bill when it would be put up in public domain, and we'll have, again, entire year would be discussing on the new act or the new bill. So we have to learn, unlearn and relearn. So that is the first major, amendment. Act will be put up in the public domain. My dear friends, what was the act? It would become 50% at least. 50% would be reduced. I can tell you, I cannot tell you everything, but 50% would be reduced. 120 to 150 sections, redundant sections, rules, etc. will go out. It would be washed away. And then, basically the act has been drafted by the bureaucrats themselves. So, what they wanted to do is to put the section and subsection, that is all. They do not want to, to complicate further by adding a clause, adding a subclass, adding a proviso, adding, item, etc., explanation, etc. All these they are telling will not be there in the new bill. But section and subsection is inevitable. It cannot be avoided. Now, what about the halla about this budget? For heaven's sake, when Madam at the end of the speech told that 14 lakhs, you need not pay any tax. Exemption has been increased to 14 lakhs. Is totally wrong. I will take you back to 2019 again when same thing when, our, at that time, Piyush Goyal, same mistake, same, the thumping of the desk by the Lok Sabha members. Similarly today, the claps and thumping of the desks and again Modi ji, chanting Modi, Modi, Modi. It is again, it's only rebate under 87A. What has increased, my dear friends? What was 0 to 3 has become 0 to 4. Up to 12 lakhs, we need not pay tax, but you will have to necessarily file return of income. Do not think that, up to 12 lakhs, I need not file return of income and I need not pay any tax, which is totally wrong. If you want to claim rebate under 87A, which Madam has now increased in this budget up to 12 lakhs, then you will have, filing return of income is a must under 87A. To claim that rebate. What the slab is tinkered is what was 0 to 3 has become 0 to 4. And thereafter, what was increased 3 to 6, 6 to 9, 9 to 12, 5%, 10%, 15% has now become 0 to 4, 4 to 8, 8 to 12, 12 to 16, 16 to 20, 20 to 24, etc. One interesting slab, 25% has kicked in, which was not there in the earlier years. Now, as we go, one more thing, the government has done is they have released FAQs, which is, a wonderful thing, You are having the memorandum, you are having the finance bill, you are having the finance minister's speech. Along with that, FAQ is released. So I think roundabout there are around 36 FAQs. So along with the memorandum, along with the budget speech, along with the 36 FAQs would make it crystal clear. Absolutely crystal clear. What is the intention of the government? In any case, my dear friend, the decade-old Income Tax Act, this is the last year. Rejoice about this Income Tax Act 1961, which will no more be alive. From the next assessment year, when you see, when the new bill probably would become a new act, taking all our suggestions, etc., stakeholders, this will be the last year when this Income Tax Act 1961 basically would, be in our administrators. And anyway, the old provisions will have to be, argued based on the, the pending appeals would have to be argued, etc., on the basis of this old Income Tax Act, which would continue to stay for a few more years. Now, let me take you to my presentation. Now, if you see, my dear friends, what is Madam telling? I'm happy to inform this August House and country that the new income tax bill will carry forward the same spirit of Nyaya. Earlier, that Bharatiya Danda Sanhita was replacing what is the new act, Bharatiya Nyaya Sanhita. Same vision, Madam wants to take it forward. New bill will be clear. Word used by Madam is clear. Direct in text with close to half of the present law in terms of both chapters and words. So Madam is telling it would be clear. Words used, English used would be simple. Words used would be clear and direct in text with close to half of the present law in terms of both chapters and words. So half of the law is out, as I told you, roundabout, it would be 50% of the present act. It would be simple to understand for the taxpayers and tax administration, leading to tax certainty and reduced litigation. This is $1 million question. So unless the act, when it's put in public domain, the bill, and we go through the contents, and then we have our opinions, so we would not be able to discuss on this, aspect as such. Now, moving further, my dear friends, then there is, in the budget speech, there is a rationalization of all the TDS rates, which is also welcome. As and when we go there, we will try to do. I want to finish all 36 FAQs so that what are the amendments made in budget, a macro analysis. All 36 FAQs will go through. It's easy to finish, nothing to worry. All the important amendments can easily be done. So if you see here, what Madam is telling, after 2014, nil tax slab rate was raised to 2.5 lakhs, further raised to 5 lakhs in 19, and to 7 lakhs in 2023. This is reflective of our government's thrust on the middle class taxpayers. Today's newspaper, if you see, what was it? Modi has invoked Goddess Lakshmi. We want the blessings of Goddess Lakshmi for all the middle class. So whether the blessings have come, 100%, sir. The blessings of Goddess Lakshmi has come through this budget, and she is putting more money in the hands of the taxpayers by, increasing the slab rate and also increasing the rebate up to the limit of 12 lakhs. And for salary taxpayers especially, it would be 12 lakhs plus 75,000 standard deduction, 16 IA. So up to 12 lakhs 75,000. There is no question of payment of any tax. You will have to claim rebate on 87A, but you'll have to file the return of income. Go forward. And let me tell you, it is very much clear that 12 lakhs your without taxation is only for the new regime. It is not for the old regime, sir. Old regime, the old taxes, the old limits continue. This is only for the new regime. Now let us move forward, sir. Now what is the revised tax structure proposed by Madam? 0 to 4 lakhs nil, 4 to 8 lakhs 5%, 8 to 12 10%, 12 to 16 15%, 16 to 20 20%, 20 to 24 lakhs 25%, above 24 lakhs 30%. What are the benefits? What are the benefits now? If you see, a taxpayer in the new regime with an income of 12 lakhs will get a benefit of 80,000 in tax compared to the present existing regime. Person having income of 18 lakh will get a benefit of 70,000 in tax. Then person with an income of 25 lakhs gets a benefit of 1 lakh 10,000. Because of this benefit, all this benefit, 1 lakh crore is the revenue foregone in direct taxes by the government of India. Now, this is a table where you can see all this total benefit and rebate benefit for those earning below 12 lakhs. This presentation anyway shared with Deepak and he can circulate, nothing to worry. Now moving further, sir. Rest all, there is no tinkering, firms, companies, etc. all remain same. So this is your 87A. Now from assessment year 26-27 onwards, this 87A limit of 7 lakhs increased to 12 lakhs and the limit of rebate in clause A, first proviso 25,000 to 60,000, etc. Now this is FAQ 1, which we like to just discuss, FAQ 1, so that we can cover this. What is new regime? New regime provides for concessional tax rates and liberal slabs. However, no deductions are allowed in the new regime other than those specifically like 80JJAA, ATM, standard deduction, etc. Now, what are the tax slabs in the earlier new regime they are telling? We discussed that up to 3 lakhs nil, 3 to 7, 5%, 7 to 10, 10%, 10 to 12, 15%, etc. New slabs proposed? Yeah, 0 to 4, 0%, 4 to 8, 5%, 8 to 12, 10%, etc. So beyond 24 lakhs, it is 30%. This FAQ are released by Government of India, don't worry. So this is the table. Clear cut, they are telling what is the benefit now. To claim benefit of nil tax liability, what are the steps required to be taken? Very important. Even if there are businessmen or even if there are any, of the chartered account, don't worry. You can easily understand. We will talk in a simple language. The benefit of such nil tax liability mentioned above is available only in the new tax regime. Please do not get confused. This is only available in the new tax regime. The new tax regime is the default regime. To avail the benefit of rebate allowable under proposed provisions of new tax regime, only return is to be filed, otherwise no other step is required to be taken. Now, new tax regime is applicable to person being an individual or HUF, etc. Now, changes in slab rates will benefit all these persons. Now, whether the limit of total income for nil tax payments has increased in this budget. Nil tax payments has been increased to 12 lakhs in this budget, provided the taxpayer files ITR to avail the rebate. It is clear, sir. Question number 9 of the FAQs. Very much clear. You want to claim, you don't want to pay tax up to 12 lakhs, please file the ITR. Why? You will have to avail the rebate. What was the earlier limit? Earlier limit, for nil tax payment was 7 lakhs. By increasing this limit to 12 lakh rupees, around 1 crore assessees. Please understand. Question number 10. Around 1 crore assessees who are earlier required to pay tax varying from 20,000 to 80,000 will now be paying nil tax. Is standard deduction on salary available in new regime? Yes, sir. 75,000. So therefore, it is 12 lakhs plus 75,000. What was standard deduction available in old regime? Yes, sir. 50,000 is still available. How many taxpayers will benefit from the new tax rates and slabs? Presently, for assessment year 24-25, about 8.75 crore persons have filed their ITRs. All such assessees who are paying tax in new tax regime will benefit from the change in rates and slabs. So what is the extra amount available to taxpayers as a result of this change? Approximately 1 lakh crore will be made available in the hands of taxpayers by virtue of changes in slab rates, rebates, etc. Then there is marginal relief also. In the new regime under 115 BSc subsection 1A, marginal relief is available only to those resident individuals who have income just about 12 lakhs. For example, if the person is having income of 12 lakh 10,000, if there was no marginal relief, what would be the tax, sir? It would be, 61,400 minus 5% of 4 lakhs plus 10% of 4 lakh and 15% of 10,000, etc. However, due to marginal relief, the amount of tax to be actually paid is 10,000 rupees. So then they are giving the benefit of marginal relief also. Now, what is the maximum amount of rebate available to any taxpayer? Maximum rebate available is 60,000, which is there for a taxpayer having income of 12 lakhs, on which tax payable is as per the new slab rates. Now, whether special income having special rate, such as capital gains, lottery income is eligible for rebate. No rebate is not available on income from capital gain or lottery. This is all given as per FAQ, sir, or any other income on which special rate has been provided in the Act. It is available only on the tax payable as per slabs under 115 BAC. What is the difference between rebate and marginal relief? So rebate is the deduction from tax which is available to taxpayers having income up to 12 lakhs in the new regime. Marginal relief ensures that taxpayers having income marginally higher than 12 lakhs do not pay tax more than the income in excess of 12 lakhs. IFSC continues. Long back, our beloved PM went to Dubai, and then he saw their concept of IFSC. Same that gift city, he took that and put it in Ahmedabad. Other than Ahmedabad, gift city is not there anywhere in India. So that he put that gift city there. And then, IFSCs have been, since then, have been getting all the benefits and deductions and exemptions under the Act. It is now also, telling that, IFSC can also commence its all activities, increased by 5 more years. Last date was 31st March 25, extended by 5 more years. Move forward, sir. Every year, they are increasing the benefits and as well as exemptions to IFSC. So is the case with this year also. Now, there is a concept of this presumptive taxation extended for a non-resident. Presumptive taxation is also extended for a non-resident, providing services for electronics manufacturing facility. So, they want to make India a global hub for electronic systems, design, manufacturing, etc. Comprehensive program for development of semiconductors and display of manufacturing ecosystem in India approved by Government of India. So, therefore, it has been represented that non-residents will be providing support in setting up of such electronic manufacturing facility by deploying technology and providing support services. Therefore, new section is introduced in this old Income Tax Act 1961, 44 BBD, which deems how much 25% of the aggregate amount receivable by or payable to non-resident on account of providing services or technology as profits and gains of such non-resident from this business. This will result in an effective tax payable of less than 10% of the gross receipts by a non-resident company. Now, again, you come to the FAQ. What is the benefit given by Finance Bill 25 to non-residents engaged in the business of providing services or technology to a resident company engaged in electronics manufacturing facility, including semiconductor? So what are they telling? Prior to this, what was the scheme? Non-resident or a foreign company was liable to tax as business income on the profits from this activity at applicable rates. There was no separate scheme for presumptive taxation. Now, what are they telling? We are bringing in the simplified method of presumptive scheme to bring in tax certainty for certain specified businesses. That is to reduce the compliance cost and also promote ease of doing business and certain percentage of sales or turnover gross receipts. So 44 BBD says 25% of the aggregate amount received or receivable or paid or payable to the non-resident will be deemed as profits and gains of non-resident from this business. Now, what about your tonnage tax scheme for inland vessels? So tonnage tax scheme, yes, there is a chapter 12G of the Act, and then, it is applicable to all the shipping companies. So this tonnage tax scheme is now extended to even inland vessels. Inland vessels also it is extended now. Now, what has happened is, 12G, I told you, chapter 12G, etc. And who are allowed, sir, for tonnage tax scheme for a presumptive taxation? Based on the net tonnage of the ship. How to calculate is net tonnage of the ship and number of days involved. So, what was happening? Presently, only sea-going ships, qualifying sea-going ships registered under Merchant Shipping Act 1958 are eligible to avail tonnage tax schemes. So now what are the change proposed? The change proposed is benefit of taxation under the tonnage tax scheme. It is also now extended to inland vessels registered under the Inland Vessels Act 2021. Henceforth, companies engaged in the business of inland water transportation can also avail benefits of tonnage tax scheme. Move forward, sir. Now, this is another, simple, but far-reaching amendment for all small charitable trusts and institutions by increasing their period of registration from 5 years to 10 years. So it is also proposed one more amendment, good amendment is, suppose your form, your application is incomplete, etc. Now, the department would overlook all these minor defaults and defects, and then your registration would not be cancelled. So therefore, that specified violation definition, that is also tinkered. It will not be any violation, because if there is a violation, you'll have to pay tax on accredited income as per Chapter 12 EB. So therefore, even if the form is incomplete, etc., there is no violation, and therefore there is no requirement for the trust to pay tax on accredited income based on Chapter 12 EB. That fair market value of the assets less liabilities, etc. So now what has happened is, this 5 years or provisional registration where activities have not commenced at the time of filing application for registration for a period of 3 years. So that is now increased. They are telling for all the smaller trust, or institution, Madam has proposed to increase the period of validity of the registration of trust or institution from 5 years to 10 years. Without giving effect to provisions of 11 and 12 does not exceed 5 crores. During each of the 2 previous years, it comes with the condition less than 5 crores during each of the 2 previous years preceding to previous year in which application is made. So all small trust and institutions have been, taken into consideration. Now, if you see this FAQ, period of validity of registration of the trust or institution with income below 5 crores, very simple, has been increased from 5 years to 10 years in certain cases. Rest it will continue. Amended provision shall be applicable to certain small trust or institution whose total income does not exceed 5 crores in each of the 2 previous years preceding the previous year in which application is made. Now, what about specified violation? Under current provision, an incomplete application for registration is treated as specified violation. This may result in cancellation of registration and consequently fair market value of assets become chargeable to tax. In order to prevent harsh consequences for default of filing incomplete application, above amendment has been carried out. So trust or institution shall be able to complete the application and same shall be considered for the purpose of registration. This is a welcome amendment again. Now 13.3 also they have tinkered. So that 13.3, 13.3 applies to all the specified persons. Who is a specified person? Who has contributed amount of 50,000 is aggregate up to the end of previous year. So that contribution will be considered as substantial contribution. So that substantial contribution, what are the change from total contribution exceeding 50,000 rupees up to the end of relevant previous year, that 50,000 has now become 1 lakh rupees during the relevant previous year. There are 2 limits now. It was 50,000 now, substantial contributor. Now they are telling it is 1 lakh during the relevant previous year or exceeding 10 lakh rupees in aggregate up to the end of relevant previous year. Sir, so it is either 1 lakh exceeding 50,000 up to the end of relevant previous year, it has become 1 lakh up to the end of relevant previous year, or exceeding 10 lakh rupees in aggregate up to the end of relevant previous year. Therefore, amendment has been made so as to not consider relative and concern in which such person has substantial interest as specified person under 13.3. Now move forward, sir. Rationalization in taxation of business trusts. So this reads and invades. So what is the amendment made here? The business trust would invest in a SPV through either equity or debt instruments. And that special taxation regime 115 UA, there is a pass-through status to business trust in respect of interest, dividend, and interest income and dividend income received by the business trust from the SPV in the case of both REITs and InvITs. Especially in case of REITs, there is rental income also. So such income is taxable in the hands of unit holder unless specifically exempted. So now what are they telling? 112A. What is telling? 115 UA provides total income of business trust shall be charged to tax MMR subject to provision of 111 and 112, no problem. That reference of 112A is not mentioned in subsection 2 of 115 UA. Therefore, 112A provides tax on long-term capital gain in case of long-term capital asset being an equity share in a company or unit of an equity-oriented fund or unit of a business trust. Therefore, now there is a proposal to amend 115 UA2 saying that the total income of a business trust shall be charged to tax at MMR subject to the provision of 111A, 112 as well as 112A. So 112A was not mentioned. Now 112A is also mentioned. That is your 12.5%. Now, if you see here again this FAQ 11, it is covered by FAQ 11. What changes have been brought into provision relating to business trust? Reference of the income under the head capital gains of the nature chargeable 112A was missing in provisions relating to business trust. See how beautifully they have given. Very, very simplified manner. FAQ has been brought out by the government. Reference of income under that capital gain chargeable 112A was missing in the provisions relating to business trust. This said reference has now been introduced by amendment of 115 UL. Now the income of the business trust chargeable 112A shall also be charged at the rate provided under such section and not at MMR. Move forward, sir. Yeah, bringing clarity in income on redemption of unit-linked insurance policy. So, 1010D, present 1010D, it provides exemption for the sum received under life insurance policy, including bonus. What is the condition? Premium payable for any of the year during the entire term of the policy should not exceed 10% of the sum assured. So now, the benefit of exemption 1010D, they wanted to restrict to only genuine cases of life insurance. So amendment was made in Finance Act 21, where they told what, suppose your premium is more than 2,50,000 or more than 5 lakhs. In case of unit linked, as well as in other cases 5 lakhs. So then what happens? They told that it would be taxable, it would not be exempt. Now, what are the amendment in this ULIP? What are they telling? ULIP is a capital asset only. They are telling ULIP will become a capital asset when the exemption of 1010D does not apply on account of 4th proviso, 5th proviso. However, in the case of life insurance policy other than ULIP, some will be chargeable to income tax under that other sources for any such policy to which exemption under clause 1010D does not apply. In case of ULIP, if suppose 1010D does not apply, please treat it as a capital asset. In case of all other insurance policies other than the ULIP, if the sum is chargeable to tax under the head other sources, then for such policy to which exemption under 1010D will not apply, please treat it as income from other sources. Now, let us see the FAQ. So that will be more easy. So what are the starting like? What is 1010D? That is, exemption on sum received on life insurance policy, including bonus, etc. What are the conditions to be fulfilled to claim exemption 1010D? First is what, on or after 1st April 12, your premium should not exceed more than 10% of capital sum assured. Then, amount of premium, that is on in terms of life insurance or ULIP, both it should be 10%. Then, amount of premium or aggregate amount of premium payable during the term of the policy should not exceed 2,50,000 for ULIP or 5 lakhs for other policies on or after certain dates. That is 21 amendment was made. If the conditions are not fulfilled, sum received under insurance policy may be charged to tax as capital gains for ULIP or other sources for policy other than ULIP. So what is the amendment now in Finance Act 2025? In the present provisions, in the case of ULIP, even where premium payable exceeded 10% of the sum assured, sum received on redemption was not being charged to tax as capital gain under 45(1)(b). Even though it was not exempt, there was ambiguity regarding head of chargeability. Current amendment has now been made the tax treatment given to all ULIP policies consistent. Simple is telling 1010D does not apply to ULIP. Please tax it under the head capital gains or income from other sources for other insurance policies. So 1010D does not apply to ULIP, charge it under capital gains. Does not apply to other insurance policies, please charge it under that income from other sources. Now, move forward, sir. Yeah, this benefit of startups, 80 IAC, this, is again now extended up to, 5 years, more than 5 years, they have extended by 5 years. And they are telling, madam is telling that benefit would be available to all startups incorporated on or before 1st of April, 2030. Now, this TDS rationalization. Para 137, you see the budget speech. I propose to rationalize tax deduction at source by reducing number of rates and thresholds above which TDS is deducted. Further, threshold amounts for tax deduction will be increased for better clarity and uniformity. Limit for tax deduction on interest for senior citizen doubled from present 50,000 to 1 lakh. Similarly, annual limit of 2.4 lakhs for TDS on rent is being increased to 6 lakhs. This will reduce the number of transactions liable to TDS, thus benefiting small taxpayers receiving small payments. These are all the budget speech. Let us see the amendments made now in the TDS regime. Now, 193, interest on securities. What is the current threshold? Nil. Proposed threshold is 10,000. Similarly, 194A, interest other than interest on securities. Suppose your bank interest, etc., FD interest, etc., 50,000 for senior citizen has now become 1 lakh for senior citizen. 40,000 in the case of others is 50,000 now. 10,000 increase. Then when the payer is bank, cooperative society and post office, here for that 50, 40 has become 1 lakh 50 is only when the payer is bank, cooperative society and post office. 5,000 in other cases and 10,000 now. That 5,000 has now become double 10,000. Similarly, dividend, current threshold is 5,000. It is now increased to 10,000. Then income in respect of units of mutual fund 194K, 5,000 has become 10,000. Winnings from lottery, crossword puzzle, etc. Aggregate, what was the current threshold? Aggregate of amounts exceeding 10,000. Now 10,000 respect of every single transaction. Similarly, insurance commission was 50,000. It has now become 20,000. 194G is income by way of commission, price, etc. on lottery tickets. 15,000 has now become 20,000. And commission or brokerage 15,000 is now 20,000. 194I rent, again far-reaching consequences. 2,40,000 during financial year. Now increased to 50,000 per month or part of a month. 6 lakhs per annum. Fees for professional technical services, 30,000 has now become 50,000. Income by way of enhanced compensation, what was 2.5 lakhs has now become, 5 lakhs. Move forward, sir. So these are all amendments done, crystal clear. Now, you move forward. This TDS and TCS, if you see here, these are all the FAQs. So we just went through those several provisions. Now this 206(1)H remittance under LRS and overseas tour package program, what was up to 7 lakhs has now become 10 lakhs. That 7 lakhs and 5%, etc. Remittance and LRS is increased now. 7 lakhs has now become 10 lakh of rupees. Forest produce, okay. Yes, TCS, this is welcome amendment for all the businessmen. Sales in exceeding rupees 50 lakhs. Henceforth, no need to collect TCS. 206(1)H has been removed from the statute. They are telling you concentrate on 194Q. Purchases made 0.1% is sufficient. So 206(1)H, you forget it. I don't want to trouble you. I don't want to trouble the businessman. Capital blockage is there. Confusion is there, etc. And then, the seller does not know, the buyer does not know if TCS is done and whether this fellow, always it is happening. TCS is done, TDS is done, and then capital also becomes, block here. Representations received that it becomes difficult for seller to check whether the buyers have ensured the compliance of TDS deduction 194Q. This results in both TDS and TCS being made applicable on the same transaction. These are all applicable from 1st of April 2025. So this FAQ 21. Reduction in compliance burden by omission of TCS on sale of specified goods. Now, what changes are proposed in 206(1)H? So we discussed TDS is applicable on 194Q at a rate of 0.1%. Existing TCS provision provided TCS is not to be collected if TDS is deducted on same transaction. However, at the time the collector is not aware of the fact whether TDS has been done away by the buyer on such transaction, this results in both TDS and TCS being applied on the same transaction. It is therefore proposed that provisions of TCS on sale of goods will not be applicable from 1st April 25 onwards. How will the amendment benefit the taxpayers? It would provide certainty to the buyer as well as the seller, reduce compliance burden on the seller. And this will also result in avoidable blockage of liquidity, from which date taxpayers will not be required to collect TCS from 1st April 25. This is, I think, block assessment. Now, block assessment, what have they done, sir? Sir, block assessment, they have tinkered with the definition of undisclosed income. In the definition of undisclosed income, they have also added, what is that? Virtual digital asset. So that they have added one, virtual digital asset. And again, now they have tinkered with the time limits. So if you see here, what are they telling now? What was the time limit for completing assessment first, prior to Finance Bill 25? What was the time limit, sir? 12 months from the end of the month in which last of the authorization for search or requisition has been executed. So now what are they telling, sir? 12 months from the end of the quarter. Same thing, in which last of the authorization for search or requisition has been executed. Again, in the definition of undisclosed income, money, bullion, jewelry, a valuable article or thing or expenditure or income based on any entry in the books of account, other documents, etc. To this, they have added the word virtual digital asset now. Then again, in the definition, any expense, exemption, deduction, allowance claimed under this act found to be incorrect, etc. These are all undisclosed income in respect of the block period. Now, again, what are they telling now? Yeah, virtual digital asset has been added, fine. Whether a change has been made in computation, what change has been made in computation of total income of block period? What is this? Provide appropriate treatment for income based on the books of account maintained in normal course. Reference to income declared by taxpayer in the block return has been provided as undisclosed income declared. Then 271 AAB down. Naturally, 271 AAB, when it started, sir, after the 1512 to 2016. 15/12/2016, and it applies only up to the 31st August. After 1st of September 2024, you know that this this block assessment came into play. So therefore, they are telling the provisions of penalty provision on 217 AAP shall not be applicable to the assessee in whose case search has been initiated on 132 on or after 1st of September 2024. So 217 AAB, I told you, on or after it started, after search initiated on or after 15/12/16, and not applicable for searches conducted on or after 1st of September 2024. So therefore, what will happen, sir, after 2024? 271 AAB, you are telling, no, it will not come. It will happen only up to 31st August. 115 BFA. 115 BFA will have penalty will be levied from on or after 1st of September. How much is, sir, quantum, sir? 50%. Penalty will be 50% from under 115 BFA. Move further, sir. This time limit for retention of seized books of account or other documents are rationalized. Time limit for retention of seized books of account. Now, what was the limit, sir? Before this, sir, it was 30 days from the date of the assessment, or could retain seized books for 30 days from the date of the assessment or reassessment recomputation order. Conditions for recording reasons, those are all remain same, sir. For retaining the books for additional period and prior approval from higher authorities, same. Now, what is the amendment made here? 132(8) has been amended to provide that assessing officer can retain seized books now for a period of 1 month from the end of the quarter. 1 month from the end of the quarter in which assessment or reassessment or recomputation order has been made. But the conditions for recording the reasons in writing by the AO for seizing the seized books of account, other documents for additional period, prior approval, etc., shall continue to apply as it was earlier. Now, under 275, what is 275, sir? Time limit to impose penalties. Bar on the limitation of penalties, 275. So what is 275? What is the problem? It is having multiple timelines, sir, for imposition of penalty. For example, the appeal before ITAT, time limit to impose penalty, end of financial year in which connected proceeding has been completed, or 6 months from the end of the month in which appellate order is received. Example, whichever is later. So different time limits are there for JCAT appeals, for commissioner appeals. Therefore, it is very difficult for the department to keep track of multiple time barring dates for effective and efficient tax administration. So now they are simplifying, sir, 275. Any penalty under chapter 21, any penalty under chapter 21 shall not be passed after expiry of 6 months from the end of the quarter in which connected proceedings are completed, or the order of the appeal is received by jurisdictional principal commissioner or commissioner, or the order of revision is passed, or the notice for imposition of penalties issued, as the case may be. Consequential amendment is also proposed in 246A of the Act to update reference of the amended section 275. So now the time limit is 6 months from the end of the quarter in which connected proceedings are completed. Now, if you see here, let us move forward. These are all FAQs. Now, clarification regarding commencement date and end date of the period stayed by the court. Yeah. So in this, what was there, sir? Clarification regarding commencement date and end date of period stayed by the court. So what has happened, suppose the assessee goes to the court and then gets an injunction and respective provisions are stayed. So the court shall be, how to calculate that? Any court shall be excluded in computing the time limit for conclusion of the proceedings. What is the period during which proceedings are stayed? That period would be, excluded. However, there is ambiguity regarding commencement date, end date. Regarding commencement date and end date of the period stayed by an order or injunction of any court required to be excluded. With a view to removing any ambiguity, it is now proposed to amend the said provision so as to exclude the period commencing on the date on which stay was granted by an order or injunction of the court and ending on the date on which the certified copy of the order vacating the stay was received by the jurisdictional principal commissioner or commissioner. Very clear. FAQ 34 is also there. Move forward, sir. Rationalization of provisions related to carry forward of losses in the case of amalgamation. So now what is happening? Basically, if you see here, what are the present provision? In the case of, your amalgamation or business reorganization, etc., accumulated loss of the predecessor entity is deemed to be the loss of the successor entity for the previous year in which amalgamation or business reorganization is affected or brought into force. Now, how many years it can be carried forward? Accumulated loss of predecessor entity. Accumulated loss of predecessor entity can be carried forward for 8 assessment years from the previous year in which amalgamation or business reorganization is affected. So 8 years he'll carry forward. Again, one more amalgamation or business reorganization takes place. Again, first period of 8 years, 8 years, 8 years. So now what are the changes proposed? He's telling now the loss of the predecessor entity will be allowed to be carried forward for 8 assessment years from the assessment year in which the loss was first computed for the predecessor entity. Therefore, after amendment, the period of carry forward of loss shall be computed from the year of its first occurrence in the hands of the first predecessor entity in which such loss had occurred instead of the previous year in which amalgamation for business reorganization has been affected. So this proposed change will be applicable for any amalgamation or business reorganization affected or brought into force on or after 1st of April 25. What is the need for this change? Excuse me. The present provisions may result in indefinite carry forward of losses if there is a series or chain of amalgamations. Therefore, amended provision plug this loophole for amalgamations on or after 1st of April 25. Move forward, sir. There are some amendments in even, your transfer pricing, etc. Removal of higher TDS TCS for non-filers of return of income. This is a welcome amendment, sir. They are telling only if you don't have PAN, I will levy that penalty. Otherwise, I will not levy that higher rate. 206AB and 206CA. What was that? The deductor is filing return of income or not. That is now removed. What are they telling? Representations received from various stakeholders difficult for the deductor collector at the time of deduction collection to verify whether returns have been filed by deductee collectee. Deductor cannot verify whether this fellow has filed the return, resulting in application of higher rates of deduction collection, blocking of capital, increased burden, etc. Now they are telling, yes, sir, we are removing 206AB or 206CA, but you cannot save non-PAN cases. Non-PAN cases, same higher rate would be applicable. So what is the 206AB and 206CA? See the FAQs. 206AB mandates deduction of tax at higher rate where the deductee is a non-filer of the income tax return. Similarly, 206CCA mandates collection of tax at higher rate where collector is a non-filer of income tax return. What are the changes? They are telling, I want to remove both these sections now. Why? How it will benefit? For any deductor collector, it was very difficult to ascertain whether a return has been filed or not by the deductee or collectee. Therefore, in case of uncertainty and to avoid default, higher tax is collected by deductor or collector. This change will provide now certainty and will improve ease of doing business and reduce compliance burden of the deductors collectors of the TDS TCS. However, mind you this, higher rates of TDS TCS in event of invalid PAN or no PAN shall continue to apply. These are all applicable with effect from 1st of April 25 onwards. So now there is increase in limit on the income of employees for purpose of calculating perquisites. 17.2 is there. Already it is there. What is perquisite? Value of benefit, amenity granted, provided free of cost, concessional rate, etc. by an employer to an employee under the head use income under the head salaries as a monetary benefit does not exceed 50,000 rupees. So that 50,000 rupees is coming since Finance Act 2001. Further, proviso to 17(2) provides that any expenditure incurred by employer for travel outside of India on the medical treatment of an employee or any member of the employee's family shall not be included in perquisite, subject to the condition that gross total income of such employee does not exceed 2 lakhs. This is also there, my dear friends, since Finance Act 93. These limits on the income of the employee for purpose of calculating perquisites put in place more than 20 years, 30 years back. Therefore, there is a need to adjust these limits accordingly to take into account changes in standard of living and economic conditions. It is now proposed that provisions of 17 may be amended so that power to prescribe rules may be obtained to increase the limit on the gross total income of the employees so that the amenities and benefits received by such employees would be exempt from being treated as perquisites. Again, the expenditure incurred by employer for travel outside India on the medical treatment of such employee or his family would not be treated as a perquisite. Welcome amendments. This is the FAQ number 12. That 50,000, they are going to prescribe. The central government would prescribe what was 50,000, per annum and what was 2 lakhs per annum. Now 80CCD. One more amendment, 80CCD. Contribution made to NPS Vatsalya scheme. It was started in September 24. So, to enable all the parents and guardians for a national pension scheme for their children. So this is exclusively designed only for the minors and will be operated by the guardian for the exclusive benefit of minor till they attain majority. When a minor attains 18 years, account will continue to be operational, transferred to the child's name with the accumulated corpus will be shifted to NPS Tier 1 account or other NPS scheme. It is now proposed to extend the tax benefits available to the NPS under 80CCD to the contribution made to NPS Vatsalya account also. So deduction to be allowed to parents, guardians total income of the amount paid or deposit account of any minor under NPS to a maximum of 50,000, as mandated 80CCD 1B. The amount on which deduction has been allowed under subsection 1B of 80CCD or any amount withdrawn will be charged to tax when such amount is withdrawn in the case where deposit has been made in account of minor. And the amount on which deduction has been allowed and is received on the closure of account due to death of the minor shall not be deemed to be the income of the parent or guardian. Now this NSS scheme. See, when we were articles, 30 years back, 25, 30 years back, there was one scheme called the National Savings Scheme. Those days, we used to claim that there was a section called 80CCA. So this NSS scheme long back, I think 91, 92 it was there. So 80CCA, we used to claim deduction. And then, only on maturity, on withdrawal, it used to be taxed. So now what is happening? Number of the very senior citizens, they have these old NSS schemes. Interest is no longer payable on such accounts. So madam is telling now, all the withdrawals made from NSS by individuals on or after 29th of August 24, I propose to exempt. I am also proposing to allow similar treatment to NPS Vatsalya as is available to normal NPS subject to overall limit. So what is this now? National Savings Scheme. That 80CCA, it provided for a deduction to an individual or HO for any amount deposited in NSS. No deduction would be allowed in relation to such amount on or after 1st April 92. Then subsection 2 of 80CCA provided that where such amount together with interest accrued on such amount standing to the credit of the assessee, it would be deemed to be income. Since this provision has been sunset from 1st April 92 itself, amount taxable on withdrawal are those which were deposited in financial year 91-92 and earlier, and on which deduction has been claimed. Further, Circular 532 is what withdrawal on closure due to death of depositor not chargeable in the hand of legal heirs. Now, the Department of Economic Affairs issued a notification dated 29th August 24. You will be interested why the date is coming 29th August 24. No interest should be paid on the balance in NSS after 1st of October 24. Clearly, they told that we will not pay any interest on the balances in NSS after 1st of October 24. Representations were received to suitably amend 80CCA to provide relief to individuals facing hardship who were compelled to withdraw as a result of this notification. So they are telling, it is therefore proposed to amend 80CCA to provide exemption to the withdrawals made by individuals from these deposits for which deduction was allowed on or after 29th day of August 24. This exemption is provided to deposits with the interest accrued thereon made before 1st April 92, as these are the amounts in respect of which deduction has been allowed. So these are the FAQs. 80cc allows deduction to individual HUF, amounts so deposited, withdrawn during lifetime of depositor, same is charged to tax. If deduction was allowed under 80cc earlier, if the withdrawal is after his or demise, no tax liability, no deduction 80cc in relation to such amount available since assessment year 92, 93, etc. Now, move forward. When is the benefit available to NSS withdrawals by Finance Bill 25? Benefit will be available to individuals who withdraw funds from the NSS on or after 29th August 24. What are the benefits given by Finance Bill 25 to NSS depositors who chose to withdraw their amounts as no interest is to be credited in NSS account on or after 1st of October 24? 80cca amended to allow tax exemption in respect of amounts withdrawn by individual on or after 29th August. The exemption has been provided only in respect of NSS deposits for which deduction at 80cca was allowed earlier. This shall enable the NSS depositor to withdraw their funds lying in NSS without any tax liability. Why I am taking you to this? Read the memorandum, read the section, read the finance bill, read the FAQ. Totally in sync with each other, sir. Totally in sync with each other. Now next, your annual value of self-occupied properties, you knew that you can claim as nil only on fulfillment of certain conditions. So considering the difficulties faced by taxpayers, is now proposed to allow the benefit of two self-occupied properties without any conditions. What are the conditions? Because of the employment or profession, etc., or carrying on a business, you are staying at some other place. So if you see the FAQ, it is clear. What are they telling now? Prior to Finance Bill 25, annual value of a SOP was taken as nil if it was occupied by owner for his own residence or if he cannot reside therein due to the reason of his business, profession or employment. Now what are they telling? Whether the conditions of 23.2 has been relaxed in Finance Bill 25. FAQ is telling annual value of SOP is now to be taken as nil if it is occupied by the owner for his own residence or if he cannot occupy due to any reason. Therefore, the additional condition of not being able to reside therein due to his business, employment, profession has been done away with. Very simple, sir. Example also they are giving. I have one house in Bangalore wherein my mother is staying. I have another house in Mumbai where I am staying. I have third house in Delhi which is vacant. After Finance Bill 25, can I take annual value of these houses as nil for taxation purposes? Annual value of the house property can be taken as nil for taxation purposes only if no rent or any other benefit is derived from such property. However, this benefit is in respect of only two properties. Therefore, the taxpayer can choose two out of the three properties in this example for determining the annual value of such properties as per 23.2 of the Act. Crypto asset. Obligation to furnish information respect of crypto asset. Now, last 2 years back, that VDA was introduced 115 BBH. Whenever there is transfer of VDA, your virtual digital asset, it should be taxed at 30% without any deduction in respect of expenditure other than cost of acquisition to be allowed. And that VDA was defined in 2 within bracket 47A, 2 within bracket, 47A, etc. Further, that 194S was inserted in the statute for TDS on payment for transfer of VDA at the rate of 1% of the transaction value, including cases where transaction occurs partly in cash or partly in kind, etc., etc. Now they are telling 285 BAA is being inserted. What? Same information, 285 BAA. Obligation to furnish information in respect of a crypto asset. Now you come to FAQ, sir. Now, what is the amendment made in proposed Finance Bill 25? Prescribed reporting authority, your entity, shall provide prescribed information in respect of transaction of crypto asset for such period and in such time and manner to such income tax authority as may be prescribed. Who will be required to furnish information of crypto asset? A reporting entity as may be prescribed on section 285 BAA will be required to furnish information of crypto asset. So, information in respect of transaction crypto asset as may be prescribed on 285 BAA, it will come now, will be required to be furnished by reporting entity. Reporting entity shall be the entity as prescribed in income tax rules in this regard. Now, what is the reason? Why is it being made obligatory to furnish information of crypto asset? Please understand question number 9 of FAQ 23. India has been included in the list of 52 relevant jurisdictions for the purpose of CARF, Crypto Asset Reporting Framework, which provides for automatic exchange of tax relevant information. The G20 leaders' New Delhi declaration called for swift implementation of CARF. To enable this, an amendment is being brought for the prescribed reporting authorities to furnish information of crypto asset. Now, increasing the time limit to pass order on section 115 VP. 115 VP pertains to method and time of opting for tonnage tax scheme. And then, if you see here, yes, what was the current, time limit to pass order under this section? Joint Commissioner has to pass an order granting or refusing the approval of option given by taxpayer for the tonnage tax scheme within 1 month from the end of the month in which application received. This is the present time limit. Within 1 month from the end of the month which application was received. What is the new time limit? 3 months from the end of the quarter in which application has been received. Now, excluding the period such as court stay, etc. for calculating the time limit to pass an order. Now, this section 2066A deeming a person to be an assessee in default for failure to collect tax. If you see here, what is the time limit provided in 2067A? No order in 2066A of the Act can be passed after expiry of 6 years from the end of financial year in which tax was collectible, or 2 years from the end of financial year in which correction statement is delivered on 2063B, whichever is later. So what are the changes now? While computing the time limit under 2067A of the Act, it is proposed to exclude the period for which proceedings were stayed by any order or any court. From when will these changes take place? From effective from 1st April 25. Now, exemption from prosecution for delayed payment of TCS in certain cases. You know that 206CB is 276BB provides for prosecution in case of failure to pay the tax collected at source to the credit of central government. And then 276BB, what is the amendment made now in this 276BB? It has been amended to provide that prosecution shall not be instituted if the person has paid TCS to the credit of central government before the time prescribed for filing the statement. That is all. So what happens if the person does not pay TCS even after expiry of time prescribed for filing statement? Then present provisions of 276BB shall continue to apply because the same provision was there for TDS. Same provision is now brought about for TCS also. That is, you please pay the TCS before the filing of the statement, like in TDS. Certain penalties to be imposed by the assessing officer. Now, there is an amendment here. If you see the FAQ, what were the penalties are imposed by Joint Commissioner under the Income Tax Act prior to Finance Bill 2025? Like 271C, D, DA, DB, etc. were imposed by the Joint Commissioner. While Finance Bill 25, penalties under these sections shall be levied by the assessing officer in place of the Joint Commissioner. Understand carefully. However, where penalty amount exceeds the limit specified in 274(2), such penalties shall be imposed only after approval of Joint Commissioner. I think 10,000 or 20,000. Yeah. Here it is. After Finance Bill 25, can penalties on 271C, these 1, 2, 3, 4, 5, 6 sections be imposed without approval of Joint Commissioner? No. AO shall take prior approval of the Joint Commissioner for passing of penalty order where the penalty amount exceeds the limit specified in subsection 2 of 274 of the Act. Presently, the limit for penalty amount at 274(2) is 10,000 for ITO, 20,000 for the AC or the DC. This 270A, again, there is a tinkering of the time limit. What is the time limit for processing application for assessee under 270AA prior to Finance Bill 25? Processing application was 1 month from the end of the month in which application of assessee was received. Now, what is the time limit, sir? It is extended. While Finance Bill 25, time limit for processing application of the assessee 270AA has been increased from 1 month to 3 months. 1 month from the end of month in which application received to 3 months from the end of month in which application for immunity is received by the assessing officer. Now, the last amendment, we'll just try to complete, that is of updated return. So updated return facility, it came in 22 and up till 90 lakh taxpayers have updated their incomes by paying additional tax. So says the Honorable Finance Minister. So now I want to propose to extend the time limit to file updated return for any assessment year from the current limit of 2 years to 4 years. So 139(8)(a), it is amended now. So what was it, sir, earlier? Up to 24 months, beyond 24 months, up to, up to 12 months, then 12 months up to 24 months. So 25%, of interest and penalty, 50% of interest and penalty. Now she's telling go up to 4 years. That means what? It is 4 years. That means the tax, interest and penalty, what was 20, your 25%, 50% will now become 60% and 70% based on 36 months as well as up to 48 months. So now it is 60% and 70%. Update return can now be filed up to 48 months because 4 years. Now, what is the additional income tax to be paid for 24 months? Update return expiry of 24 months up to 36 months. It is 60% of aggregate of tax and interest payable. What about additional income tax to be for filing every updated return expiry of 36 months from the end of relevant assessment year up to 48 months. Again, they are telling 70% of aggregate of tax and interest payable on additional income disclosed in updated ITR. What is the rationale? Why you are increasing for updated return up to 48 months as per amendment brought? This is in line with philosophy of trust first. What Madam told in the budget speech, scrutiny next. The facility of updated return up to 48 months will enhance voluntary compliance. Can a taxpayer file more than one updated return? Not possible, sir. However, one updated return for every year you can file. Can a taxpayer file updated ITR after filing revised ITR? Certainly, taxpayer after filing revised ITR can file updated return. He can now file updated return for any previous year at any time within 48 months from the end of relevant assessment year. Now, can a non-filer taxpayer file updated ITR? If yes, what will be his additional income tax liability? Yes, sir. Non-filer taxpayer can file updated ITR, for the previous year at any time for the previous year within 48 months from the end of relevant assessment year. So what will be the additional income tax liability for an additional income disclosed in updated ITR in different years? First year, that is within 12 months from the end of relevant assessment year, 25% of aggregate of tax and interest payable. Second year, that is after expiry of 12 months from the end of relevant assessment year, within 24 months from the end of relevant assessment year, 50% of aggregate tax and interest payable. Third year, that is after expiry of 24 months from the end of relevant assessment year, but within 36 months from the end of relevant assessment year, what is the additional tax payable? 60% of aggregate of tax and interest payable. Fourth year, beyond 36 months from the end of relevant assessment year, but within 48 months from the end of relevant assessment year, it would be 70% of aggregate of tax and interest payable. Now, why was there a need to extend updated ITR from current 24 months to 48 months? Philosophy, they are telling government philosophy to trust the taxpayer. It is intended that voluntary compliances are increased and taxpayers should come forward with true disclosure of their income and should utilize the facility of filing updated return instead of going through the prolonged process of assessment reassessment proceedings. Now, under what circumstances, sir, you cannot file updated return? Return of loss, whether your tax liability is decreased on the basis of return filed 139.1, 139.4, 139.5, refund is increased or the refund is increased. Then if there is a search initiated, etc. Now move forward. So this is specified undertaking of a unit trust of India. That's okay. So my dear friends, at the end of the the amendments, we tried to cover some major amendments. The government has to forego 1 lakh crore on direct taxes, 2,600 crore on indirect taxes on account of changes in tax rate. My thanks to the entire team of KSCAA led by its able president and Deepak Chopra. Thank you very much for a very patient hearing.
Sorry, sir, I was on mute.
Yes, sir.
Sir, on behalf of KSCA and Direct Tax Committee, I extend my heartfelt gratitude to Naveen sir for his insightful analysis and for sharing his valuable perspectives on Budget 2025 in such a short span of time. Special thanks to all our participants for joining us today in such large numbers. Your enthusiasm reflects the importance of staying updated in an ever evolving tax landscape. As we await the introduction of new Direct Tax Act next week, KSCA will continue to bring timely discussions to keep our members well informed and updated. Thank you, sir. Thank you. Thank you all.
Thank you.
The session stands formally concluded. Thank you.